Hello everyone, welcome back to my channel. Today, I'm going to be talking about how I traded SPY calendar spread amid the CPI report release. Before I get into this, please hit the like button and subscribe to our channel. We're building a mobile app for retail options traders to quickly generate and assess options ideas. If you're interested, please visit www.odds.trade and sign up to be our beta user. CPI data for June 2022 was scheduled to be released on 8:30 a.m. July the 13th. Many traders expected the data to go off the charts and therefore loaded with straddles or puts to speculate on the potential huge move after the CPI release.
So earlier during the day of July the 12th, I noticed from the SPY option chain that the implied volatility from the July 13th expiration was substantially higher than those from the later expirations. It was also very clear from the volatility smile that the out-of-money options for July the 13th has a much higher implied volatility than the rest. I believe it was the uncertainty around the CPI release that drove up the July 13th implied vol.
Going into this event, traders are piling up puts or straddles expire on this day to bet on the directional move after the CPI release. This actually created opportunities for option sellers to capitalize on the potential volatility crush for the weekly expiration that right next to the CPI announcement date.
So I decided to trade a at-the-money calendar spread by selling July the 13th put and buying a July the 18th put. The strike price for both contracts were at $384. I chose July the 18th put over the July 15th because the 18th volatility was lower. That would suffer less impact from the IV crush after the CPI release. I'm Butterfly is a direction neutral strategy, which means I'd be profitable as long as the stock price moved within a specific range, and I didn't have to guess which way the stock was going to go. Break-even points for this trade by the end of the first expiration cycle were $378 and $390. The max profit was $250 and the max loss was $164. This was a high probability play with a 70% chance of profit.
Right before market close on July the 12th, I was pretty much break-even despite the last hour sell-off and recovery. Since the CPI data will be released on 8:30 in the morning the next day, I was thinking I might close the position right after the market opened the next day if it generates about 50% of the total profit. This is a very small size bet, so my downside risk is rather limited.
At 8:30 a.m. July the 13th, Bureau of Labor Statistics released a shocking 9.1% CPI increase year over year. SPY plunged 2.3% during the pre-market session. However, stock climbed from the opening 375 all the way up to the closing 379, indicating only a 0.5% drop from the day. Throughout the day, I hit 65% return multiple times as shown in the blue arrow. But eventually, I exited 4 minutes before the market closed when the price retrieved from 381 to 379. I spent $4.32 buying back the short put, which I sold for $3.03. I also collected $6.42 from selling the long put, which I bought for $4.67. So my total return was around 25%. This turned out to be a decent trade, and I was happy about the return. And the lessons learned from this trade were, first of all, take profit at 50% is not a bad idea for a calendar spread trade like this. Second of all, I opened the position around noon on July the 12th, which was probably too early. I would have been able to take profit earlier if I submitted the trade before market close instead.
I hope you find this video helpful. If you like it, please hit the like button and subscribe to our channel. We will publish more trade research in the future, so stay tuned and see you next time.